Hello, this is Victor Cuevas with Victor for Advice. This is part 2 of this video where we're talking about whether it makes sense to save for retirement on a tax-deferred basis, or should we just go ahead and pay the taxes up front, save with after-tax money, and then not have any taxes in retirement. I'm going to go with the latter, have no taxes in retirement. That would be a nice thing. But as you know, as a review from the first video, if you get with a CPA, he's going to do what CPAs do. They want to be your hero. They want to save you as much money as possible. So if you're self-employed or you own a business, they will tell you, hey, just open that retirement plan and just sock as much money as you can into it because you're going to save big. And you're going to get that tax break. And that might not be the smartest way to save for retirement when it comes to the taxes. And what I want you to do is just use your common sense. And I'm going to show you the numbers, but just try some common sense here and don't go with the conventional wisdom. Because I will tell you, I've been in this industry for over 25 years. When I came in, they taught me just what everybody's showing you these days. I did retirement plans. I did it for school teachers. I traveled all over the state of Georgia at the time, doing employee benefits and retirement plans, and I used to, be on contract with different companies to go talk to their employees about their retirement plans and their employee benefits. I worked as an estate and financial planner for a firm, and I did retirement plan, and life insurance, and life insurance. I did all that stuff, and it was all about, hey, you're going to save on your taxes. You won't have to pay tax on the money you contribute. And it wasn't until later on when I started seeing what was happening in the stock market and with retirement accounts and things, especially after 2008, then I realized, you know what? There's other strategies out there, and I started looking at them, and now my whole perspective has changed over the last several years. And that's why I want you to see now. Again, use your common sense. So here's bankrate.com. I've gone to the retirement income calculator and I put a scenario in here already of a business owner or a self-employed person is going to contribute $50,000 a year for the next 15 years. That person is 50 years old and he wants to retire by age 65 and he wants 30 years of retirement. Which is, you should hopefully live to your 95. I'm just going to leave it at 30 years. You should plan at least for 30 years of income in retirement to be on the safe side. $50,000 a year. I'm going to put here rate of return before retirement. I'm going to put 5%. Now, if you're working with an advisor that's taking a fee like I used to for a period of time, you're going to pay 2 to 4% back to the investment firm and to the third-party people that they employ, and you make 9%, you're going to end up with 5. If you try to do it on your own, you're not going to be able to. Most people aren't going to stick with it. They're going to go up and down. They get busy with life, and next thing you know, they're not doing that well. So I'm just going to put a reasonable 5%. That's what, statistically speaking, it's less than that. If they go through all thousands and millions of retirement accounts over the years and, 401ks are high fees. So, look, 5% every year is very reasonable, and all we can do is an average. So I'm just putting 5%. And I'm going to put rate of return during retirement while you're drawing income at 4%. You might get more. You shouldn't be drawing more than 3% of your income and of your nest egg in retirement, just to be on the safe side. That's what most of the experts are saying these days. But I'm going here with the scenario with bankrate.com on their projected income. So here I put a 28% tax bracket during accumulation years. Now where did I get that? I come down here. And if I put 28% tax bracket, filing jointly, that would be someone making 153 to 233. So let's say this person is making 230,000, 220,000. and they decided, look, I've got to catch up. I haven't been saving for retirement. I'm going to put $50,000 a year, one way or the other, over the next 15 years, and then I'm going to pull the plug. All right? So they may sell the business and have some extra money, but this is a nest egg that they want to set up for the next 15 years, $50,000 a year. That's the scenario. And then in retirement, we're going to put them in a 25% tax bracket because they're going to be earning $5,362 a year, a month. You throw in their Social Security, especially for both of them, and you're looking at $75,000 to $153,000 a year. It's going to put them in a 25% tax bracket. Nice little retirement, right? So let's go. 28% tax bracket during accumulation, 25% tax bracket in retirement. We got a 2.9% inflation rate that plays out over here. All right, now, at the end of 15 years, they're looking at $5,362. Well, before I come to that, let's see how much money they're going to save contributing $50,000 a year if they follow their CPA's advice and make it all tax deferred. Well, we have a progressive tax rate, so it's not all taxed at 28%. You've got these brackets you got to go through. Once you hit that 153, you're going to hit that 28%. So if you average this out, let's suppose they end up on the average on the 20% tax rate. So if we go $50,000 here, right, that they're contributing, and they save 20% on tax, that's $10,000. Okay? Now they're going to save for the next 15 years, and they're going to save $50,000, and then they won't have to pay $10,000 in taxes for each year. That's $150,000 in taxes this person's going to save. And they're going to think, wow, I did pretty good. I saved $150,000 over the last 15 years. My CPA took good care of me. It sounds good, but is it really good? Well, let's look. The monthly income is $5,362 before tax. And this is federal tax. Doesn't include state taxes if you live in a state that taxes your income. I'm being generous again. $5,362. Federal tax, they're looking at take home $4,021. All right. So let's look at that. 5,362 minus 4021, right? That's $1,341 a month in taxes they're paying. Times 12, $16,092 a year in taxes. That's more than the $10,000 they were saving, right? Now let's look at this. They're going to live 30 years with this income, paying $16,000 a year in federal tax, times 30. That's $482. Let me write that. $482,760 in taxes. Federal tax over the next 30 years. I'll let that sink in. This person was proud and their CPA was happy to save $150,000 in taxes over 15 years. But now they want that nest egg they built to stretch out and feed them and clothe them and house them for the next 30 years, during which time Uncle Sam is going to collect $482,760, almost $500,000. Okay, which is better? I want you to, again, use your common sense. Which is better? Save $150,000 over 15 years or pay $482,000 over 30 years. Save $150,000 when you're out there hustling and making money and you can afford to pay the extra $10,000 a year in taxes because you're earning $200,000 or $180,000 or whatever. Or get in retirement and have to pay $482,000. $500,000 over your lifetime. What if you could retire with that same income, or even a little less, maybe $5,000 or $4,900, but not pay a lick of tax for 30 years? Not one penny in federal tax for 30 years on that nest egg. And save several $100,000 during your lifetime. What could you do with that extra money? And think about this. You retire and you leave some of that, maybe there's $200,000 left in that nest egg. One of you broke even and just broke even and stayed ahead and you started out with a nest egg. Maybe there's $300,000 left. Now you leave it to your heirs. They're going to get taxed on that $300,000. So one of your heirs, let's say the tax bracket, they're in a 28% tax bracket, and let's suppose they made $200,000 or $300,000 that year, and now they inherit $300,000. Now they're going to lose 50% of that between state and federal tax. What if you could leave your remaining nest egg tax-free? Don't pay taxes on it during retirement and leave it tax-free to your heirs. What if you accumulate this nest egg and you're 70 and you pass on? And there's $500,000 in there, $600,000, $700,000 in there. I mean, when there's 800,000, $1 million, then it goes all to your heirs. You're going to lose 50%. State and federal. 45%, 40%, a big chunk. Gone. The government is going to take way more than $150,000 you saved initially contributing to it. So those are the numbers, folks. I mean, you can play this any way you want. I mean, you could put $10,000 a year, $20,000 a year, 30, 40, 50, 100,000 a year. It doesn't make any difference. Doesn't make any difference. It's all going to get taxed. Whatever you saved in retirement, if you live an average retirement lifespan, you will pay, and then you have some left over and it goes to years. That money is going to be taxed way, way, way more than you ever saved in taxes accumulating it. So that's all I wanted you to see. Does it make sense for me to take the tax break now? Or should I take the tax break later? By tax break later, I mean tax-free income in retirement. And I can show you how to do that. I can show you how to take that $50,000 or whatever amount, $10,000, $100,000 a year, $30,000 a year, whatever you want to put away for your nest egg over the next 10, 15, 20 years. I can show you how to put that away someplace where it's safe, it's not at risk, it grows nicely, and guess what? When you retire, tax-free for the rest of your life. And when you leave this world, tax-free to your heirs. It's a beautiful thing. Now, if you already have a current IRA, maybe it was an 0401k that you roll over into an IRA, or you have an 0401k from a previous employer, and I can show you then how to make sure that you get this return. I can even show you how to do it without any fees. so you get a better return. I can also show you how to enhance your income over that period of time. And when you get ready to retire, instead of trying to worry about, well, is the stock market going to keep up? What if I have 2 down years? Well, in 2000 and 2001, 2002, going on 2003, we had 3 years in a row where the stock market was down. How would you like to be, drawing money from a nest egg and go 3 years when the market is down? How is that going to affect your income for retirement? I can show you how to protect that so that you will get a higher income in retirement that you would from your 401k or IRA, and that income will never go down, and it'll just be guaranteed the rest of your life. Even if you run out of money, you still get paid. I call it creating a personal pension plan for yourself. So I help people save money, tax-free money, and so I just encourage you to consider what I've shown you here. Use your common sense. See if the conventional wisdom is really the way you want to go with all of your money or some of your money. And then, just contact me and let's talk. Let's go over your certain situation, what you want to do, and let's see if the strategies that I now use are strategies that could work for you. All right, this is Victor Cuevas with Victor for Advice. God bless, and I hope to be talking to you soon.